Hello guys, wonderful good morning. Join me. Yoo-hoo. Hi Lilian. Hello, hello. Guys, get ready, get your coffee. Join me. Hello guys, the usual suspects. Nice. Also welcome, good morning to the viewers on YouTube. Number one, I love it that it's 9 o'clock, shitty weather, and you still come to class. That's the right attitude. Number two, I know it's very early for serious stuff, but I want to talk about the end of our course. I don't know if you are aware of it. This is our 10th lecture. Officially after today we have 4 more lectures and that is it. So the closer we get to the end of our course, the more accurately I can predict how much time I will still need to present and explain new content. So I'm already at a stage where I can do this now. So I'll need you obviously today for introduction options. Then in our next lecture, I show you option pricing, which typically takes a little bit more than 1 lecture. So I don't want to rush through it. If we do options for about 2.5 lectures, we have all the time in the world to build it up really very thoroughly, step by step and very patiently. That's I think how it should be done. Then I need 1 more lecture to cover 2 chapters together. Not because they are related, but because they are small sort of cherries on the cake. One you have already discussed in the first year, efficient markets. So I just want to highlight a couple of things from that chapter. Specifically, I've been in touch with many of you about your special interests. And quite a few of you want to talk about behavioral finance, which I think is amazing. And when we look at efficient markets, we can hyper-focus on behavioral implications. There's nothing complicated. Not because it's exam relevant, but because it's super interesting and it tells us something about human nature. So not only in the context of finance relevant, it's just a very interesting topic to understand humans. So I would love that. And we do it together with working capital management. I will show you the cash conversion cycle, also not rocket science. So long story short, I need you for about 3 more lectures. It means we have 1 more lecture scheduled where we need content. Now yesterday, I received the official midterm report from SR. So thanks guys for, by the way, doing this. And it was a very pleasant read. And quite a few students said, well, with workshops we would like to practice exam questions more. And that's a bit difficult because whatever I practice with you in depth in class, I will not in that exact same form give you on the exam. I mean, the idea of the course is not to train you to pass one specific exam. So I thought, what can I do? Because on the other hand, I mean, I understand. I speak from a perspective of finance and I want to train you for the real world. But I understand that I have to acknowledge that you're also students and I mean, the exam is relevant for you. So I kind of get it. And I thought, can we combine this? Can we combine my, not passion necessarily only, but my drive to teach something meaningful with a bit of exam training? And I think we can. So my suggestion would be, in the last lecture, I bring last year's exact exam, the theory part, so the part that I create. Don't forget, Celine creates the calculations. I create everything theory related. So how about I bring this and we simply go through it because the exam is designed to cover everything to some degree. I told you about 25% questions easy, 50% average, 25% a bit more challenging. So we could easily in 1 lecture go through the whole theory exam. We look at the question, you tell me a little bit how you would answer. You know, I ask questions that you can answer in 1 or 2 sentences. I say afterwards a couple of things, explain a little bit, and we move on to the next question. So if that sounds appealing to you, if that's a suggestion where you say, yeah, let's do it, post a comment on YouTube because that's where I look for feedback, okay? Then just let me know and we'll do it. And the last thing before we hop in, quite a few of you have asked me to upload my research paper. It's called Born of Necessity, the origin of convertible bonds in the Netherlands. So I uploaded it indeed to our canvas. I also made the disclaimer, it's not exam relevant, obviously. Still, I would like that you read it. So like I said in my Telegram message, it's considered a rather interesting read. Especially look at...
Recording in progress.
Oops. Look at part 3. Chapter 3, 4 and 5 that are specific cases, specific firms that almost reads like a crime story, if you will. But the reason why I would encourage everybody to read it, it's about capital structure. So it's a specific instrument that we are talking about, convertible bonds. but we're trying to figure out where in the pecking order theory.
You're muted.
You think I'm muted? Wait. Hold on. Give me a sec. Super weird. My Zoom just muted me. Weird. Thanks for pointing it out. You can hear me now again? I don't know. It's too early for my computer, apparently.
We can hear you.
Thanks. Thanks, guys. I lost track. Yeah. So it's basically we are trying to figure out where in the pecking order theory does a convertible fit in. So you will recognize, first of all, the cases that I'm describing, like I said, part 3, 4, and 5. You can just read this like a crime story. It's very engaging. And it pertains to capital structure conversations, to the whole first part of the course. This is an actual research paper, so you will recognize a lot of the stuff that we have talked about in class. So it's not going to be a waste of your time. But if you say, I only look at stuff that's in this form on the exam, you obviously don't need to do it. Yeah, so that is it. On the agenda today, introduction to options. So I want that you know exactly what I would like you to focus on today. So options are a financial instrument, like a stock or like a bond. So it's something that you can basically invest in, that you can buy, you can trade it, you can buy it and sell it. And just like a stock or like a bond, it gives you certain rights and privileges. So for example, if you buy a stock, it makes you a shareholder. You're entitled to go to the annual shareholder meeting, to vote on matters of great importance. You're entitled to receive a part of the future profits. So that are the rights that come with owning a stock. If you are a bondholder, don't forget, a bond is nothing else but a huge loan that you extend, basically that you give to a company by buying their bond. What are the rights that you get from buying a bond? Well, you get the right to get your money back so that the company repays you, and you get the right that they not only pay back what they have basically borrowed from you, but that they pay you also from the firm's perspective interest expenses, from your perspective interest income. So an option is a financial instrument like that. Only it's very different. And that's what we will do today. I want to explain to you in diagrams the 4 basic option types, or let me say the 2 basic option types, but each of them you can buy or sell. And we will in a diagram determine then what is gonna be your actual payoff. So today I would like that you focus on not how a payoff diagram looks like, but how we create it. Okay, so I will do this by pointing out which question you have to ask yourself as you are creating a payoff diagram. Everything that I will sketch out on the smartboard today, I have of course slides for our next lecture, is there as well in perfect, neat style. So today sketches will be perfectly enough for your understanding. I want that you already know everything I sketch out, you have in the neatest way possible in the slides that I will upload for our next lecture. Okay? Let's hop into options. Today I need a bit of a different background because it's all about drawing. Okay, so I told you an option is a financial instrument. It's something that you can buy or sell. But I also said, well, it's like a stock or a bond in the sense that you can buy or sell it, but it is very different from that. So let me explain what's different. So what is different about it? So number 1, an option belongs to a very different category of financial instruments. The category is called derivatives. Oops, wrong color. Derivatives. So a derivative is an instrument that does not really have a value by itself, but the value of a derivative is, as the name indicates, derived from the value of something else. Okay? So that makes it automatically more complicated. There's something now I need to mention a couple of terms. I would like that you study them like vocabulary. It's like learning a language. Okay? There's nothing to not understand. That's just weird finance language for normal words that you know from everyday life. Okay? Let me write this down And this is something that you should try to internalize as quickly as possible, so simply that we can speak about it properly. Okay? So I want to write down already the 4 basic options that we can deal with. That are the 4 basic option types. That is my minimum agenda for today, that I will explain what each of that is and how the payoff diagram looks like. That's my minimum output. I would actually like to go a little bit further and show you how you can even combine them to get even crazier payoff profiles. And to be honest, I want to go even one step further and already take the first step in pricing these bad boys. The problem is not understanding what you can do with them or how they work. The problem is how much should you be willing to pay for one of those, okay? Now let's talk about, is there a question?
Yes, just a quick question.
Shoot.
Is it called long shell or shell?
Neither. Yeah, valid question, but it's neither. It's actually long call, like a phone call.
Oh, call, yeah.
Long call, short call, long put, and short put. Okay, let's talk about what that actually means. Like I said, nothing to not understand. It's just weird finance language that we have to master. So what does it mean? What does long in finance mean? The term long in finance simply means to buy something. I always tell my students the following story, and they think I made it up. It's not made up, it's real. When I was studying with a lot of traders that were trading stocks and bonds for a living. And when we, after studying, went for drinks together, and it was very late and we were a bit drunk, and we went to a hot dog stand, they really say, drunk to a hot dog dude, I go long with a hot dog. Because for a trader, it simply means I buy it. Okay? So long in finance simply means to buy something. So if somebody says, I have a long position in a stock, what does it mean? Well, somebody has bought a stock. That's all there is. So take an educated guess what the word short means then. If long means to buy, you have probably suspected correctly. The word short in finance means to sell something. Nothing fancy. It's simply like another word. So that is relatively straightforward. Okay, we still need to talk about what does the word call mean and what does the word put mean. And that is really now specific option terminology. Long and short you will encounter in finance in all kinds of contexts. Call and put only in the context of options. So what is a call? A call option means the right to buy. Let me write that down as well. The right to buy. And then obviously the word put is the opposite of this. So what does put mean? A put option gives you, big surprise, the right to sell. The right to sell. So that are the 4 combination possibilities. Really there are only 2 kinds of options. There are call options and there are put options. But what can I do with a call option or with a put option? In each case I can buy it or I can sell it. So what does it mean when we're looking at a long call? What is a long call option? A long call means you buy the right to buy something that we have to discuss. What is then a short call? Well, short means to sell. So a short call means you sell the right to buy something that we will still have to address. What is a long put then? It means to buy the right to sell. And last but not least, what is a short put? It means to sell the right to sell. Something that we will have to discuss. So that are the 4 basic, I would say, option positions based on the 2 option types, a call option or a put option. Okay? Is everyone on board so far, guys? I'm always patient with all my students but today with options, I have even more patience than normal. So the moment I say something that is unclear or needs a bit more explanation, please immediately ask, okay? That's absolutely crucial. Okay, so what does it mean when I say I'm talking about a long call? Somebody bought the right to buy. And I said, yeah, but what? That we still need to address it. In order to be able to talk about this as well, I need to introduce some more terminology. Again, this is like studying vocabularies. There's nothing to not understand. Okay, so I need to explain the term underlying. Underlying. So I said, okay, a long call means to buy, the right to buy something that we will have to address. That something is called underlying. So what is a long call? It means you buy the right to buy the underlying. I realize perfectly well that this is a crap explanation because it's just a complicated word. What can the underlying really be then? If I buy the right to buy the underlying, it's relevant. What is the underlying? The underlying can be anything. So just to give you a couple of examples maybe. So the classic example would be that the underlying is a stock, a share. Then of course the whole thing would be called a stock option. Yeah? So the underlying could be a stock, then we talk about a stock option. The underlying could be a commodity. I explain in a second what that is. A commodity is simply complicated finance blah blah for essentially a raw material, like oil, like pork belly, like gold, stuff like that. And basically everything else. You could even have as an underlying an interest rate. You could have as an underlying a specific weather condition. Then it would be called a weather derivative. So the weirdest thing is possible. When we go through our payoff diagrams, I want to make it very tangible and not too abstract. So I want to do an example where we look at an example where the underlying is a commodity. Okay. So long story short, what is an option? Well, an option is a financial instrument whose value is derived from the value of something else. And now I can tell you from what the value of an option is derived. It's derived from the value of the underlying. Because if I have the right to buy the underlying, obviously the right to buy the underlying, the value of the right to buy the underlying will strongly depend on the value of the underlying itself. And there's something still missing, and that's probably the most important thing. You buy the right to buy something, what? The underlying. Two important points now. At some point in the future, for a price we fix right now. All right, that's gonna be the game changer. Let me write this down as well. Okay, so the price that we agree on to be applied in the future is called strike price. Strike price. And we agree on the price right now, but it will be applied in the future. Okay, is everyone so far on board? It was just a bunch of terms. What I would like to do is, in today's class, to work this off systematically with you. And I don't know if you can already tell, if not, this is no big deal, but long and short are sort of opposites, okay? So the opposite of a long call is not a long put. The opposite of a long call is a short call. This here means to buy the right to buy. What is the opposite of buying the right to buy? Selling the right to buy. So we will look at the sort of complementary positions together. I will draw one payoff diagram for long call and short call together, and another payoff diagram for long put and short put together, okay? Like I said, please, by all means, interrupt when there are questions. No problem whatsoever. So we will start with a long call. Okay. So, all right, let's do this. So we start one with the long call. which means to buy the right to buy. I want to make it a specific example, and yeah.
I was actually wondering, I don't know if I'm allowed to but like, is the price, as it depends on the underlying, is it then the same in like all four cases, because it's just dependent on the underlying and not on the value?
I suppose it's a valid question, Sabine. Today is a bit different in the lecture. Normally I encourage also completely off-topic questions, not when we talk about options, okay? We are talking about what is an option, and we are looking at the first one. I'm not willing at this point to talk about option pricing. That gets way too quickly, way too confusing, but to give you something, the prices differ. They are not always the same. So calls and puts have different prices, okay? But today I really want to focus on the actual topic we have to discuss. Pricing is very difficult, and that will be the second step in the next lecture. Let's do it. How does a payoff diagram look like? No, let me start differently. I'll give you a concrete example. I want that in my example, in all my examples, you will be a bakery. So what you do is you produce bread. I, Flo, will be a grain farmer. So what I do is I produce grain. So obviously you and me have a business relationship because you produce bread, and in order to produce bread, you need the grain that I produce. So I am your supplier. You buy every year all the grain that you need for your bakery, for baking bread, from me. But there's a problem. So this is of course a raw material. Grain is a commodity. The problem is commodity prices fluctuate. Sometimes they are very high, sometimes they are very low. So it could be that we are in the following situation. You are doing your budgeting for next year, as you have to. You are thinking how much raw material do you need for your production, but you're really worried about one thing. You are worried that the price of grain next year might increase. What would that mean for you? Well, it means your raw material, grain, can become more expensive, and if that happens, what will happen? Well, either you pass on the price increase to your customers, so you increase the prices of your breads, but then of course probably the demand for bread will go down, or you say no, you leave the price of bread unchanged, but then of course your profit margin will go down. So either way, you're very uncomfortable with the the worry, I should say, grain prices next year might increase. So you need to do something about it. Or you want to do something about it. How is my perspective? I'm a grain farmer, I produce grain, and selling grain is how I generate revenue. So what I do is, I also worry. I worry that next year the price of grain will go down. Because if the price of grain goes down, it's bad for me because that is my product, that is what I sell. If, however, the price of grain goes down, it's bad for me, but it's great for you because your raw material has become cheaper. So neither you nor me are sure how the future is gonna be. So what you do then is, you approach me and you say, hey Flo, we have a many year lasting, very nicely working business relationship. I'm your grain farmer and you are my main customer. So you say, hey Flo, how about this? We're both worried about the future. I'm very worried, you will say, I'm very worried that the price of grain will go up. And you ask me for the following thing. You ask me, hey Flo, would you, Flo, be willing to sell to you, the bakeries, the right to buy grain next year? Let me write it down. For next year. Let's say normally you buy, I don't know, grain from me for, I'm just making stuff up, 10 euro per kilogram. And you simply say, hey Flo, how about you sell to me the right to buy grain next year for a price we fix right now. How about we simply agree on a price to be applied next year, 10 euro per kilogram. And I might say, yeah, sure, happy to sell you that, because I'm relatively optimistic that the price of grain will not increase too much. So I'm willing to sell that right to you, and I'm willing to sell it to you for 2 euro. The 2 euro, that is referred to as option premium. Option premium. That is essentially, not essentially, that is definitively the price that you, the bakery, has to pay me, the grain farmer, so that I give you the right to buy grain from me next year for 10 euro per kilogram. No right is for free. If I give you a right, you will have to pay me for that. Okay? Is everybody on board so far? Is the setup roughly clear? Excellent.
Could you repeat that, please? So the 2 euros I, as a bakery, pay to the farmer, or the other way around?
Yeah, you, the farmer, want that you are the bakery, right? You, the bakery, pay to me, the farmer, 2 euro, and what you get back in return is the right to buy grain from me next year for 10 euro.
Okay.
So basically you pay 2 euro so that I give you the right to apply this price on grain next year with me. The right.
I got it.
Yeah?
Thank you.
You're most welcome.
Question.
Yeah, ask, of course.
Is it a fixed price or like variable per kilogram or something?
No, it is, that's the whole beauty. It is a fixed price. So it is a price that I promise you that you may apply. So I literally give you the right to buy grain from me next year for this price, 10 euro. No matter what the actual market price of grain will do next year. If it would go through the roof, I'm just making crazy stuff up, 1 million euro per kilo, you could pick up the phone, hey Flo, it's me, the bakery, I want to exercise the right to buy, and you give me 10 euro, and no matter at which market price grain will be traded next year, I have to deliver it to you for 10 euro. Even though I might know I could sell it at the market for 1 million per kilogram, I can't, because we have entered a contract and you have literally bought the right to buy for 10 euro from me. Okay?
So is the 2 euro a one-time payment for
Yeah.
like the whole
Yes.
the whole amount of grain we
No,
buy?
no. The 2 euro is only the price of the right. Okay? So if you want to exercise it then, you still have to pay the 2 euro. That is only the price of the right. Of the right to buy for 10 euro. If you want to exercise it, you really have to pay the 10 euro then.
But the amount of the grain we could buy is not fixed. So we can say either we want
No.
2 kilograms or 10
No.
or 20.
No, it would be fixed. So you, an option contract specifies how many units of the underlying you can buy. And you need to buy the adequate amount of option contracts to cover the amount of underlying that you may want to buy. So that is not a price that you lock in and you can then say, I want 1 kilo or I want 1 million kilos. That is really specifically for this amount. So in my example, we have a contract over 1 kilogram. I have given you the right to buy grain, 1 kilogram of grain from me for 10 euro, not more. If you wanted more, you would have to buy more of these contracts. So if you say, yeah, but typically I use 5 kilo of grains per year, then in my example, you would have to buy 5 of these contracts. Okay?
And then, for example, if you said that the market price is 1 million per kilogram, we basically have an arbitrage opportunity because we could buy like the grain and then sell it for much higher value if we have the
Exactly.
right to buy it.
But that's exactly where I want to go with this. That is what we will do now, okay? Let's do it. Let's do it. Shoot. But guys, be mindful what I said before, okay? I don't want any detours today. That's complicated enough as is. And I love it that you're interested, but I will not respond to any questions that go beyond this for now. Go.
In that case, I think my question kind of goes beyond. I was going to ask, why
Because a future, so number one for all other students, we have not discussed futures and forwards, and I think it's difficult to understand futures and forwards without knowing options already really well. But just to give you a quick response, the difference between a future and an option is, an option gives you the right, a future gives you the obligation. So yeah, you could lock in the price with a future as well, but then you are committed. With an option, you have the right, literally the right, to choose what you want to do. Okay, so that might be preferable in some situations. But let's look now at how this plays out. Okay, let's look at how this plays out. I need black. Let me sketch out a payoff diagram. All payoff diagrams have the same format. Payoff diagrams look like this. On this axis, on the x-axis, I will plot the price of the underlying in the future. Okay, so this is where I will plot the price of grain that will happen next year. Price of grain, or if you want to be more abstract, the price of the underlying. But that is the price next year. Okay, so we don't know that yet. Then we have here 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 and so on. Okay, and on this axis I plot profits or losses essentially. That's accurate enough for the time being. And what we will do is we will plot now all possible payoffs that you might experience next year. Let me show you a couple of data points that you see how the system works. It's really not complicated, so don't be too worried. I would like that you focus on the questions that I ask, okay? So that you see how to develop that, not just how the final shape looks like, but how I develop it. So we have now entered a contract. You have successfully bought from me for €2 the right to buy the underlying, so grain, your raw material, next year for a price of €10 per kilogram. But it is the right. The right means you don't have to. You can really decide, yes, I want to exercise the right, or no, I don't want to. If you choose to exercise the right to buy, you basically give me a phone call, hey Flo, I want to exercise. I have of course the obligation, right? I'm the so you are the long position, the long call. That automatically makes me the person who has sold the right to you. So I'm the short position, I'm the short call. You have the right, and that logically means I must have the obligation. We cannot both have the right. If you have the right to buy from me and I have the right to refuse, I mean, what kind of nonsense would that be? So let's play it out, okay? We will do every single data point, and I guarantee within 5 minutes it's gonna get boring because it's that easy. So we have entered the contract, we have both signed it, and then we fast forward 1 full year. 1 year later, we are now really in the next year. And in the meantime, the price of grain has gone up and down, and we will then see what is the price then really next year. And what we will do now is, we say, what if the price next year, the price of grain next year, were 0? 1, 2, 5, 10, and so on. So we just play out what will happen to you in your wallet at the end of basically next year, depending on which final price of grain we will see in the markets next year. Let's do it. Let's say the price of grain next year is 0. That's not really possible, but let's say the grain harvest is so abundant that the price of grain drops to 0. What does this mean now? Let's say next year the price of grain is 0, the market price of grain. In which position do you find yourself? You are then holding the right to buy grain from me for €10. Would you want to exercise your right? Or let me rephrase the question. Would you want to buy something for €10 that you could pick up on the commodity market for €0? Would you want to exercise your option?
No, definitely not.
Definitely not. Exactly, because you would incur an automatic loss. If the market price of grain next year were €0, why would you want to exercise your right to buy it for €10? That makes 0 sense. what's your total payoff then in this scenario?
It's a loss of €2.
Excellent. Yes. Why is it a loss of €2? Well, you will then, next year comes around, you see, the market price of grain is 0. I don't want to exercise the right to buy it for €10, and your right to buy will then expire because we have a contract only for 1 year. So the option expires, and what is your net result? Well, for the right to buy, you have originally paid to me €2, so your payoff would be -2. Does everyone understand how I get this point? You would not exercise the right to buy grain from me for 10 euro. However, we must not forget that I didn't give you the right to buy because I'm such a kind and sweet and gentle person, but because you paid me a handsome amount of €2. And the €2 stay in my wallet. So you have incurred a loss of €2. Different example. We enter this contract, you pay me €2, I give you back the right to buy the underlying grain from me next year for 10 euro. 1 year passes by and we see the actual market price of grain next year. Let's say the market price of grain next year is 1 euro. Here, would you exercise your right to buy? Would you want to exercise? I see a lot of you shaking your head no. You're absolutely right. What would be, well, again, why? Ask yourself, why would you exercise or not exercise? If the market price of grain next year were 1 euro, you hold the right to buy something that's traded then for 1 euro at the markets, and you hold the right to buy it for 10 euro from me. You would never do this. You rather buy it then from the commodity market. What is your net result? Tell me.
0,
Yeah, 0, that's only then the payoff from not exercising, but don't forget, I didn't give you the right for free, right? You had to pay 2 euro to me, so your payoff will be -2 euro.
But is it still then? Because we already paid for this year. So, anyway.
No, we are always, sorry, Philip, we are always talking about the same year. We are now in the position, we are living in the here and now we are playing out all possible outcomes that might occur next year. That's not then the year afterwards, in 2 years or in 3 years. That's every scenario we analyze might be the final outcome of the next year.
Okay, yeah. But what do we go from 1 year to next year?
No, it's just, we really talk only about 1 year. Okay?
Can I ask one thing?
Quick, yeah?
Well, I thought maybe because now the price is 1 and you can buy it for $1 at the market, it's like your loss would be -1 instead of -2. Is it like
No.
as long as you don't like exercise it, the loss will be €2?
Exactly. Yes, that's exactly how it is. You have bought the right to buy, no matter if you exercise it or not, it doesn't matter. You have paid the 2 euro already and nothing will bring them back. So you always start at -2 euro because they are gone, all right? They live now in my wallet and you will not get them back. So the only thing that we have to do is figure out the actual payoff depending on the price of the underlying next year. And we must not forget to always deduct the 2 euro that you already have paid. That's basically the trick, okay? So if the price of grain next year were 0, you hold the right to buy something with a market price of 0 for 10 euro. You would never exercise, but you have had to pay the 2 euro for me to even give you the right. That's why you end up, if the market price were 0 next year, you would end up with a loss of 2. If the price next year were 1 euro, still the same situation. You then hold the right to buy something that has a market price of 1 euro and you may buy it from me for 10 euro. Would you want to give me 10 euro just so I give you back something with a market value of 1 euro? Of course not. You would let your option expire without exercising it. What would be your payoff? Still the same -2 euro that you had to pay to me so that I gave you the right to buy. Okay? How about we enter this contract. As before, you give me €2, I give you the right to buy next year grain from me for €10. What happens if the price of grain next year were €2? Would you want to exercise? Or ask yourself, would you want to give me the €10, so the strike price, just so I give you back something that has a market value of 2? Would you want that? Of course not. What is your payoff?
-2.
Excellent. -2, because before anything happens, before I give you the right to buy, you must pay me the option premium. Otherwise, why else would I give you the right to buy? That's risky for me. I want to be compensated for my risk. Different example. We enter this contract. You give me €2 and I give you back the right to buy grain, so the underlying, from me next year for €10. We fast forward 1 year and we find the market price of grain might be €3. Would you exercise your option to buy for €10? No.
Well, it's same. I think it's until €10. It is the same because our profit, like the market price, is lower than the option price we made a deal on.
Yeah, don't say, wait a second, don't say option price. The price of the option is the option premium, right? You are talking about the strike price. Yeah, the price to be applied. Yes, you're absolutely right. So that's why I said before, this gets boring very quickly. So let's just fast forward a bit. We have here 1, 2, 3, 4, 5, 6. Let's maybe check out 6. Let's say we fast forward 1 year and we find the market price of grain next year might be €6. Would you want to exercise your right to buy something that next year might have a market value of 6 and you can buy it from me for €10? Would you exercise? No. Same logic. You would have to give me €10 just so I give you back grain, which then would be traded for €6. So that's a guaranteed loss for you. You would not exercise. 7, 8, 9, 10. How is this at 10? Let's say we fast forward 1 year and the price of grain is €10. Would you exercise?
Well, I guess not because you've already also paid €2, so
Exactly.
it's lost then, right?
You're absolutely right. So at 10, we are still in the minus zone, because if the market price of grain is €10 and the strike of grain is €10, so the price that we have agreed on that you may buy grain from me for is €10, it doesn't really matter if you exercise or not, but either way you had to pay the €2 option premium. How would it be if the price were €11? Let's say we fast forward 1 year. Next year you see, oh, wait a second, the price of grain has increased to €11. Would you exercise?
Yes.
Yeah, I think so too, because if the price of grain were €11, oops, that's here, were €11, you hold now something that's kind of interesting. You hold the right to buy something with a market value of 11, but you can exercise your right to buy it for €10. Yeah, you would exercise. What is your total payoff?
-1.
Excellent, very nice. Let me explain why -1. So the moment you observe next year that the price of grain is 11, you would realize that your right has now value. You can buy it for 10, but it's actually traded for 11. So what you theoretically could do, that's what Michael hinted at before, you could call me, exercise the right to buy, which means you give me €10, I have to give you back a kilogram of grain with a market value of 11. So if you were not a bakery, you could take the grain and immediately sell it then at the commodity exchange for the actual market price of 11. So you give me 10, I give you back grain, and you immediately sell it for 11, and thus making an immediate profit of €1. But €1 plus €1, that's not your final payoff, because in order for me to give you the right to buy, you had to pay €2 to me. So the total payoff then would be -1. We would be here. Okay? How would that be? Different example. We fast forward 1 year and you find that the price of grain is 12 euro. Would you want to exercise your right to buy from me for 10 euro? Excellent, guys. Yes, you absolutely would. Because it plays out like this. You say, hey Flo, I want to exercise. I know, of course, our contract. That means you give me 10 euro and I have to give you the grain that is actually traded for 12. Again, if you were not a bakery, you could immediately resell it then at the commodity exchange for 12 and net an immediate profit of 2 euro. What is your total payoff if the price of grain at the end of the year were 12? Exactly, 0. So the actual profit you would make from exercising the right to buy would be 2 euro. Because you give me 10, you have to pay 10 euro to me, and I give you back something with a market value of 12. So that's clearly a difference, a positive difference, a profit for you of 2 euro. But don't forget, you had to pay for the right to get the right. So, and you had to pay 2 euro. So you make a 2 euro profit, but you had to pay 2 euro. So the total payout for you would be 0. And now it gets a bit more interesting. How about next year? Different example, the price of grain were 13 euro. Would you want to exercise? Absolutely. What is your profit gonna be? Yes, 1 euro. I see a couple of students showing correctly, 1 euro. Why? Again, let's play it out in our minds. What happens if next year the price of grain were 13 euro? You hold the right to buy it from me for 10 euro. You can simply call me, hey Flo, I want to exercise, and I know exactly what it means. You will give me 10 euro and I have to give you back the underlying grain with a market value of 13, which theoretically you could immediately sell for the actual market value of 13. So you would make here a profit of 3 euro, but we must not forget that I did not give you the right to buy from me for free. You had to pay 2 euro. So you make a profit of 3 euro, but minus the 2 euro option premium. So what's your net payout? 1 euro. Whoop. How would that be if next year the price of grain were 14? Would you want to exercise? And how much would your profit be? Yes, nice, I like it. Yeah, you're absolutely right. Again, let's play it out. Would you want to exercise your right to buy? You would buy it for 10 euro, something that then has, as you see then, has a market price of 14. You would say, yeah, of course, you can buy it for much cheaper, for only 10. So you buy it, the difference here would be 4 euro, but not the full 4 euro would be your profit because I did not give you the right to buy for free. You had to pay 2 euro to me so that I gave you the right. So you make a profit of 4, but minus the 2, so you end up with a net payout of 2 euro. And this is how it goes. So let me connect now the dots, and we are done with option type 1, long call. How does the long call actually look like? It comes here from minus 2, minus 2, minus 2, minus 2, minus 2, minus 2, minus 2. Here at 10, it comes up. Whoop. And it's simply a straight line. Okay, so that is the payoff diagram of a long call option. I want to highlight now two zones, the profit zone and the loss zone. Let's do that. Let's look maybe first at the profit zone. Where is the profit zone? You tell me.
It's all above 12 euros.
Exactly. When the market price of the underlying next year is higher than 12 euro, you will make a profit. So the profit zone is all of this here. That's the profit zone. Where is the loss zone? The loss zone is everything else. This here is the loss zone. Okay? And at exactly 12 you break even because from the option contract you make a profit of 2, but you also pay 2 euro to get the right. So therefore here you would be at 0. Guys, is everybody on board? Is everybody on board? You understand how I developed every single point? Super. It's really not more complicated than this. And also just for your mindset, the first option is of course a little bit challenging because all of that is new. You will see this gets much faster. You just have to change your logic a little bit in each case, but it's not going to be more difficult than this. And now what I want to do is I want to look at the short call. So we look now at your perspective, right? At the perspective of the bakery. But there is of course another side to this, which is my side, the grain farmer. So we looked at the person that bought the right to buy. Let's look now at the person, Let's look at the payout of the person that sold the right to buy. So a short call, my position. And that is now incredibly easy because options are a zero-sum game. What that means is the profit of one party must be the loss of the other party and vice versa. So if you would, let's say, just to give an example, if you were to challenge me to a game of Texas Hold'em, which you should not do, but let's say you do, one of you challenges me to one-on-one Texas Hold'em, then afterwards other students say, hey Flo, how did the poker game go? I only have to say I went home with plus 10,000 euro. Then you automatically know how my opponent performed. If I won 10,000, then clearly my opponent lost 10,000. Cannot be any other way. And the same is true here. I am now the
Can I ask you a question?
Of course.
So basically you're like betting against the seller that the price won't be, like, you think that the price will be higher than 12 the next year and he's betting that it's going to be lower than 12.
I mean, I would not put it like this at all, but I can see why you do. So you're not wrong, but I would not put it like this. Because you look at options right now clearly as a tool for speculation. And I'm not gonna lie, options can be used, of course, perfectly for speculation. But I'm a finance teacher. I'm not teaching you how to gamble, even though I just gave a Texas Hold'em example. Sorry for that. I want to show you how you use this for risk reduction. So you phrased it very deliberately as, oh yeah, you're betting against. So you even use the wording of gambling. I would say, no, you as a bakery have engaged in a meaningful risk management strategy. You have now actually used an option like an insurance policy. Observe, you had to pay 2 euro to me. And what is the outcome of the option agreement? Your preferred outcome is that the price of grain remains relatively low, because then you don't need the option at all. You simply buy your grain at the commodity exchange for whatever the price is. Let's say next year the price of grain were 2 euro. You would of course not buy grain from me. You would simply buy it at the commodity exchange for 2 euro. And then you would let the option expire worthlessly. What's your damage? Well, the 2 euro that you paid. Sometimes people think that's super weird, and it's not weird at all. It's a bit like, because people then say, yeah, but it's such a pity, now I paid 2 euro and I didn't even get to exercise the option, and I find this not weird at all. And if you find this weird, then I have an example for you. If you live by yourself in an apartment that you have rented, I certainly hope that you have a fire insurance. I'm guessing now none of you has yet burned down their house. And I don't think that at the end of each year, you look at your insurance premiums, at your insurance payments and say, oh crap, again another year where I didn't burn down my house. That's of course exactly what you want. You want an insurance for the worst case, yet you're of course hoping that you will never need it. So a long call option can be used as an insurance against price increases in your raw material. No matter how high the price of your raw material will go, which normally pops up in your income statement as cost of goods sold, it doesn't matter, because if the price goes infinitely high, you simply exercise your option and you know the price that you have to pay for grain from your perspective can never be higher than 10 euro, because then you would always exercise. So I would look at options as a risk management strategy. Even though I have to admit, you can use it, of course, for gambling. It's a bit like looking at a knife. I look at a knife as it's an excellent tool to make a, Pindacar sandwich. And a bit, you are now asking, well, can I use it to stab somebody in the eye? I have to admit that yes, you can, but I prefer that you look at it as an ideal device for making a sandwich, okay? Would you say your question is addressed?
Yes, thank you.
Perfect.
For example, if we look now at the American commodity crop market, isn't there like a lot of gambling between the farmers, the stock market,
For sure. Yeah.
and the buyers?
Yeah.
Because basically what options make possible is price dumping, especially like in the grain market, right?
You can use options in many different ways. Like I said, today I have a very strict agenda and I'm not willing to take too many detours, simply because that's complicated enough as is. Once we have established everything, we can do the craziest stuff, but not at this point, okay? Just be a bit patient.
I have two questions. The 2 euros is kind of like some costs. Can you consider it like that?
I'm sorry, Sabina, I don't understand what you're saying. Say again.
The 2 euros, like the premium, can you kind of see it as some costs in a sense that you already paid them, so you don't need to take them into account like
Yeah,
next year?
yeah, it's sunk costs. Yes. It's literally like your insurance premium. I mean, how does your decision making change knowing that you have a fire insurance? It's something you have already paid. You still hope that you won't burn down your house. But if you do, the insurance will refund the market value of your house. The same logic applies here. So that's the reason why we teach options in the bachelor as a risk management device, not as a gambling instrument. Okay? Let's look at...
I have a question, quick question.
Very quick.
Okay, yeah. Can we have options for more than next year? For example, can we buy an option, for example, for 5 or 10 years?
Oh, yeah. Yes, absolutely possible, Philip. The question was, I don't know if everyone on YouTube heard it, can you buy options that are valid for more than 1 year? So this is just an example to keep it very simple. If I'm very honest with you, real options have a much, much shorter expiration date than a year. So, and Philip asked, can I have options with a maturity of more than a year? It's possible, but once we look into option pricing, you will see the more into the future you go, the more expensive options get. So if you wanted an option that basically guarantees you a purchase price for grain over the next 10 years, the option would be insanely expensive because everybody knows the price of grain over 10 years could be all kind of crazy stuff. So it becomes so unpredictable, it becomes very risky for the short position. So the option premium would be insanely high. But it is possible, yeah. Yes. Let's look at the short call. So that's simply the opposite. That is my position in my example. So I sold to you the right to buy. So you have the right, I don't have the right. That means I have the obligation. If you call me to exercise, I have to deliver. Okay? So how does the payoff diagram of the short call look like? Let me sketch it out in one go and then I explain. +2, short call in purple, +2, that's here. So, the purple line, this is the payoff diagram of the short call. Let's analyze why. Well, here in this part, I mean, we don't really have to discuss anything until the value of 10, of market price of 10. Because as you are not exercising, what will happen in my wallet? Nothing besides that I earn the option premium, right? That the amount of money that you had to give me so that I would be willing to give you the right to buy. I sold the right to buy. The fact that I use the word sold here means a purchase price was involved. That's exactly the 2 euro, okay? So that's what you see here. That is my profit zone, by the way. That's my profit zone as the short call. But then, let's look at, for example, 14. Let's pretend next year the price of grain is 14 euro. why would I make a loss here of 2? This is sometimes a bit difficult to understand for people because of the example I have picked. I have pretended here that I'm a grain farmer and that I produce grain. So no matter what the price of grain does, I'm sitting on a ton of grain anyway that I can sell. But when you develop a payoff diagram, you apply a slightly different approach. You pretend that the short position does not have the underlying. So what would that mean? If I were not a grain farmer, if I were not in possession next year of grain, and you call me, hey Flo, please deliver 1 kilogram of grain for the strike price of 10 euro, what would I have to do to be able to deliver grain for you, to you? I would actually have to go to the commodity exchange and buy it myself first for the market price, just so I can deliver the grain to you, right? So if the price of grain next year were 14 euro per kilo, I would have to buy it for 14, just so I can deliver it to you when you exercise. So I have to myself pay 14 euro minus 14, so I get 1 kilo of grain. You give me then 10 euro the strike price as per our agreement. So it seems like I made a profit of 4, a loss of 4, because I had to buy it for 14, give it to you for 10, that's where the 4 are coming from, but I of course made some money on selling the right to you to begin with, so my loss will not be the full 4, but 4 minus the option premium of 2. So that's how you get a loss here of, not you, me, of 2 euro. Okay? Let me sketch out now, in the payoff diagram of the short call, the profit and loss zones. Where are they? Like before, I will sketch out the profit zone in green. Where is my profit zone? My profit zone is this here. So as long as the price, the actual market price in 1 year, stays below 12 euro, I will make a profit. How much? 2 euro. And as the price increases, my losses will accumulate. Where are my losses? All of this here. Okay? Okay. I have now 4 questions for you.
But, sorry, you said as long as the price stays below 12 euro, you're going to make a profit of 2 euros.
Naja, no, I mean the profit will already decrease after 10 euros, of course, yeah. Right? But just basically on the option itself, not taking into account the option premium. Yeah.
Sure.
Yeah. I have 4 questions for you. I want that we look at the long call and the short call, and I want that you tell me for the long call as well as for the short call, what's the highest potential profit and what's the highest potential loss, okay? Let's look at it. Let's start with your position first, the long call. That's the red line here, okay? That's your position. What is the highest potential loss that you, the long call, can make?
-2.
Yeah, excellent guys. How do you have to read this? Well, this is your profit or loss, and you see at no point is your payout below this line. So yeah, the highest potential loss that you can make is minus 2 euro. That's how much you paid for the option. What is the long call, highest potential profit? Infinite. Very nice, guys. What would have to happen for you to make an infinitely high profit?
The price would need to rise.
How much? To which value? Absolutely. Very nice, guys. That's only theoretically possible, but if the price of grain were to reach the level of not 100, 1000, 1 million, but really mathematically infinite, you then still hold the right to buy 1 kilo for 10 euro. So I give you then, you give 10 euro to me, and I give you back an asset, a commodity, with an infinitely high value. So you could sell it for infinite, and the difference between infinite and what you had to pay for it is still infinite. So yes, the long call theoretically has an infinitely high profit potential, because this line here continues infinitely. Yes. Okay, what is the highest potential loss that I can make, the short call? What is my highest potential loss?
It's otherwise, so it will be infinite, yeah.
Exactly, infinite. If the price of grain reaches a level of infinite and I myself don't have it, yet you, the long position, wants to exercise, I have to buy it for infinite at the market and give it to you for 10 euro, thus incurring an infinitely high loss. Very nice. What is the short position, the short call's highest potential profit?
2.
2. I make the highest potential profit if you end up not exercising your option. Then I make a profit of 2. Yes. Is everybody on board? Let me check quickly YouTube. I want to make sure that everyone is on board. Anouk in the chat asks, what are derivatives again? Derivatives are financial instruments. That is my definition, a simple, normal human language definition. A derivative is a financial instrument which does not have a value by itself, but the value of a derivative is derived from the value of something else. And in the case of an option, the value of the right to buy is derived from the actual value of the underlying in 1 year. Okay? Okay, so if we look at this now in terms of usefulness, how would you use these instruments? Yeah, we agreed before, you could use them for gambling. So if theoretically you say, I'm virtually certain next year the price of grain will go up a lot, you could then go long on a call option. You could become a long call by paying the option premium. And if then really your expectation becomes true that the price increases, you can exercise your option and make a profit on this. That's absolutely true. But it is not the idea why I teach that. The idea is how can you use it for risk management? If you are a company and you're dependent on a raw material like grain, you obviously are happy about price decreases of your raw material. That's fine. That would increase your profit margin. But you would hate it if the price of the raw material went up, because it makes your raw material more costly. It cuts into your profits. So how do you insure yourself against rising raw material prices? By going long a call option. And then the option premium is really like an insurance premium you pay. And what are you insured against now? You're insured against price increases in the raw material. And I, on the other hand, as a grain farmer, why would I engage in this? Well, it might be that I'm convinced that the prices of grain will remain rather low. And that's a bit sad for me because it's my product. So if I know the prices of, or if I'm reasonably confident that the prices of grain remain rather low, I might as well sell the right to buy for a higher price, because in my mind this will not happen anyway. And since the price of my product is so low, obviously my revenues will be very low, but I can basically make my revenues a little bit more fat. How? By selling the right to buy. So even though I'm not happy to sell, let's say, grain for only 4 euro at the market, I actually make a little bit of extra profit from your option premium. And last thing at this point, sometimes students are a little bit confused and say, but why would anybody want to be short? I mean, if you're long, the biggest loss that you can incur is 2 euro. The biggest profit is infinite. The other way around, if you're short, biggest profit you can make is 2. Highest potential loss is infinite. Who wants to be short? It's easy to explain. I mean, for everybody who expects a price increase, there's somebody who expects or is certain that the prices will go down. So it depends on your expectations, really. Okay? So that are call and long and short call. Okay? I would now like to move on and look at the other 2 positions. Let me show you again. So we have looked at the payoff of somebody who bought the right to buy, and we looked at the payoff of somebody who bought the right to sell. So we still need to look at 2 more. We need to look at how does the payoff look of somebody who has bought the right. Oopsie, no, yeah, it's correct. long put means to buy the right to sell. Short put means to sell the right to sell. So these two we still need to address.
Ask a question.
Sure.
Should we know how we determine the option premium, or don't we learn that?
I said this now several times already. This is option pricing. Yeah, absolutely. That is exactly what will happen in the next lecture. Option pricing is something that we will definitely address. At this point, I've simply stated the option will cost you €2, and I did not explain at all where the €2 came from. So in this example, I just made them up. But in the next lectures, we have to figure out how is the option premium really calculated. And yes, you need to know this. Not now, because we have not addressed it, but definitely, absolutely, yeah.
Okay.
All right? Okay, let's look now. Let's look at the long put. 3, oopsie, I need black. Let's look at the long put. What does long put mean? It means to buy the right to sell. Everything else is the same. To buy the right to sell, the underlying in the future for a price that we fix right now. So again, we agree on a strike price of, let's say, €10. And again, we are talking about a period of 1 year. Let's look at our payoff diagram. And again, like before, I will sketch both long put and short put in the same payoff diagram. The diagrams always have the same format. On this axis here, I'm plotting price of underlying in the future. And here, again as before, I plot profits or losses. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay, so this is 10. Okay, let's analyze. Again, the long position has the right, so that again means the short position has to comply if the long position wants to exercise. Now let's look at how it plays out. Let me get red. So, when you sketch out...
Sorry to interrupt. What we buying? Switch? Because I don't... This for price 10, yeah?
I don't understand. What's the question?
Like before the long put, what we buy for the price of 10? Or can you go to the blackboard again? Yeah. Sorry. Yeah. What is next to the price of 10? Because I don't know what we buy.
The strike price.
Strike price.
Yeah.
Thank you.
The price that we agree on that you may apply in the future is referred to as strike price. Like in our previous example. It's simply called strike or exercise price. Okay? When you analyze a put option, you do it very differently from a call option. With a call, we approached in our analysis from here. When we analyze a put, we have to approach from here. So we are coming now from basically an infinitely high price of the underlying. Okay? Let's talk about this. So you hold now the right to sell to me. You are long, I'm short. You hold now the right to sell the underlying to me for €10. So let's say, that's here 10, 11, 12, let's say here, let's start with 13. Let's say 1 year from now, the price of the underlying, whatever, doesn't have to be grain, the price of the underlying is 13. Would you want to exercise your right to sell? Let me explain a little bit more what that would imply then. Like before, if you exercise your option, this will happen. So you would then sell to me for €10 something that's traded for a market price. Would you want to exercise your right to sell the underlying to me for €10 when next year the market price were 13? Would you want to exercise?
No.
No. You just have to ask yourself, would you want to sell something to me for 10, which otherwise you could sell for 13? Obviously not, because that would give you a loss. Let's also write down, like before, we had an option premium of €2. So that means in order for me to give you the right to sell to me, you had to pay €2 first. So at 13 you would not exercise. How much would your payout be, your payoff? Guys?
€2.
Exactly, -2, right? Because you had to pay for the right to sell. How would it be at, let's say, 11? We fast forward 1 year. You hold the right to sell to me for €10. Something that next year you might be able to sell for 11. Would you want to exercise?
No.
No. What is your total payout then?
Still -2. I think.
Still -2. You're absolutely correct. Because you had to pay for the right. Yeah? You bought the right. You bought the right to sell to me, and for that, for the right, you had to pay €2. How would that be? Let's look at 9. Let's say next year the price of the underlying were €9. Would you want to exercise your right to sell to me for €10?
Yes.
Yes, excellent guys, because your reasoning would be like this. Well, you want to sell the underlying anyway. If you were to sell it on the commodity market, you could sell it for €9. But wait a second, you hold the right to sell to me for more than that. You have the right to sell it to me for €10. So you would call me, hey Flo, I want to exercise. You have to give me then the underlying, which theoretically you have to buy yourself at the market for €9. And I give you back €10. What is your net payout then?
1. Wasn't it 1? No, sorry, -1. Maybe.
Yeah, very nice. Nicely saved. -1. Why? If the market price next year, I just make a side calculation here. If the market price next year were €9 and the strike is €10, then basically you buy it yourself for €9, so -9 at the commodity market. Then you sell it to me. You can force me to buy it from you. You have a cash inflow of €10. But for all of this to happen, you first had to buy the right to sell for €2. That's the option premium we paid. So we have -2, -9 is -11, plus 10 is -1. That's how I got this point. And that's the calculation I do for every single point in my head, basically. Okay?
Can I ask one question?
Mm-hmm.
So you have the right to sell, but the person you're selling it to has the obligation to take it, right?
Yes. Mm-hmm. Yeah, you're absolutely right. It's not possible for both of us to have the right. You have the right to sell it to me, and let's say I have the right to refuse it. Then it's like we have no contract, right? That makes no sense. You're absolutely right. The long position has the right to buy or sell, and the short position has the obligation to basically do whatever the long position wants. Yeah. Now let's say the price of grain or the underlying whatever next year is 8. Would you want to exercise? I recycle my calculation here. How will it play out? If the market price were 8, you could sell the underlying on the market for 8, but you can force me to buy it from you for 10. You have the right to sell to me for 10. Would you exercise? Absolutely, you exercise. So, in order to get the right to sell, you had to pay to me the option premium of 2. That's a cash outflow for you, -2. If you don't have the underlying yourself that you want to sell to me, you first have to buy it for the market price that you will find next year. So that's then 8. And I have sold you the right to sell and for a strike of €10. So that's the 10 here. And that means the net payout would be 0 then. So at 8 we have a payout of 0. Go away. Okay. Let's look at how would that be at, let's say 6. Let's say next year the market price of grain were €6. Well, you still had to buy the right to sell to me for €2. The market price of grain then is €6. So if next year comes around, you see the market price Oh, it's only 6 euro. You don't even have it yourself. Yet you call me, hello Flo, I want to exercise my right to sell to you for 10 euro. Then, of course, in order for you to be able to deliver it to me, you have to buy it yourself first. So you buy it for the prevailing market price then of 6 euro. That's this cash outflow here, minus 6. And sell it to me, and I will give you the agreed upon strike price, 10. So what is then your net payout? Minus 2 minus 6 is minus 8, plus 10 is plus 2. Okay, so at 6, you already make a profit of 2. Let's look maybe at what would happen if the market price would completely plummet to 1 euro. You still hold the right to sell it to me for the strike of 10. What would happen if the market price were 1 euro? Well, in order for you to have this right, you always have to pay the option premium to me. So the minus 2, no change there. If you want to exercise your right to sell to me, you need the underlying yourself. If you don't have it, you need to buy it at wherever you can buy the underlying, at the commodity market, for the market price then, for 1 euro. So minus 1 euro, then you can really exercise the right to sell to me. And I have to give you the agreed upon strike price of 10. So what's your net payout? Minus 2 minus 1 is minus 3, plus 10 is plus 7, right? 1, 2, 3, 4, 5, 6, 7. Okay. What would happen if the price were to decrease all the way to 0? Then you hold the right to sell something to me for 10, which has a market value of 0. How would your payout look like? That's of course your best case. You still had to pay the option premium to me, so that I gave you the right to sell to me. You don't have a cash outflow from picking up the commodity, because at this extreme point it would be worthless, so nothing here. And I have to pay 10 euro to you. Even though it's worthless, I have to comply. So what would your profit be in this extreme scenario? Plus 8. So that would be here. And now we can sketch out the payoff of the long put function, of the long put option. It comes from here, minus 2, minus 2, minus 2, minus 2, minus 2. And then it goes up. Yeah, that's not a perfect line, but I think you get the idea. And like I said on the slides, I have this, of course, super accurate. Let's talk about profit and loss zones. Where is your profit zone?
Below 8, yeah.
Yeah, if the market price remains below 8, you will make a profit. Where is your loss zone? Tell me, guys.
Above 8.
Yeah, logically here. That's all the loss zone. So somebody who engages in a long put option contract has what expectation about price developments of the underlying? What do they expect?
Infinite profits and
No, wait. Infinite profits. What's the highest profit the long put can make?
8.
Yeah.
yeah.
Strike price minus option premium. In the admittedly extreme case of the market price dropping to 0. The highest profit of the long put is strike price minus 1 option premium. That's this point here. What's the highest potential loss of the long put?
Couldn't you also say
1
that
option
the price
premium.
could be negative?
What?
The price could also be negative, right?
The price of what could be negative?
Well, let's say of the grain of the underlying.
I mean, we are now really not even in the realm of thought experiments. That's basically science fiction. I mean, I suppose you could argue that.
It's similarly science fiction, right?
Yeah, I mean, I suppose you could argue that. You could say, well, if there is a lot of grain around worldwide, the price would decrease based on supply and demand. So let's say it drops to almost 0. But de facto, it could be negative, because if you hold a lot of grain, you need to store it somewhere. So just the grain already would be considered worthless, but the fact that you have to store it in some sort of air-conditioned grain silo means you incur costs. So you could, I suppose, say it's negative. But in the real world, that would not happen. In the real world, it would not even drop to zero. So it's really unlifelike. Any payoff diagram stops at zero. And the logic is, in the world of finance, options are not only dealt with where the underlying is a commodity, but where the underlying is a stock, a share. And shares would be delisted way before their price drops to zero. So that's not an example that you have to worry about. Every payoff diagram stops at zero because everything would be delisted at this point. Okay?
Isn't that the reason why we have a par value? Because if the price drops below the par value, the share wouldn't be on the index anymore, right?
Yeah, I'm not too happy about, first of all, I mean, this is a completely different battleground, but I just wanted to say about par values of shares, that's a completely outdated concept. Modern shares only have, I mean, microscopic par values because old laws legally require firms to have that. The historic idea of par values does not exist anymore. So I would not try to connect this to par values at all. It's wasted effort, I think. I would like to look now, of course, at the second option position. We looked at the long put. We still need to look at the short put. Let's do that quickly. Short put. No need to do major analysis. You already know how it goes. Your profit must be my loss. Your loss must be my profit. So without any thinking, I can already sketch it out. Whoop. And then going down here. And the intersection here would be -8. And I want to sketch out again the profit and loss zones. Where is my, so the short puts profit zone? That is, wrong color. That is my, that is my profit zone. Where is my loss zone? My loss zone would be all of this here. Let's talk briefly about it. So when would the short put make a profit? Well, in an environment of rising prices. When would the short put make a loss? In an environment of decreasing prices. So we talked before briefly about risk management, and I said, well, a long call is a nice device, a nice tool, a nice instrument for basically buying yourself insurance against price increases of an important raw material that you use. So let's talk now about for which risk management purpose you could use a long put or a short put. You could use a long put, so that's the red line here. Why would you use that? You could use this to insure yourself against price decreases in your product. So as a grain farmer, from the previous example, I produce and sell grain. I'm worried that next year the price of grain decreases a lot. I might want to be the long put with the underlying grain, where the underlying is my product. If the prices of grain next year are very high, perfect. Then I simply let my put option expire worthlessly, no problem. And I sell my grain at the commodity market for prevailing high market prices. If, however, the price of grain drops a lot, which would harm me, because remember, I'm a grain farmer, I sell grain, that's literally my revenue. If I find next year the prices of grain to seriously decrease, I simply exercise my put option and sell it for the strike of 10. So I have now basically established a minimum sales price that I will never be able to fall below. If the price is higher than 10, I sell my grain at the market. If the market price next year of grain is lower than 10, I exercise my put and I have sort of a minimum level now, minimum sales price, the strike of 10. When would you use a short put? Well, if you're convinced, if you're expecting prices to increase, you could sell a put, you could be the short put, because you think it's very likely that at expiration of the option, the market prices will be in this range, so you might make then the profit on the option premium. Okay? Is this clear so far, guys?
Yeah, one question.
Shoot.
So like the long call is like insurance for high prices and the long put for low prices.
Yeah, but I would be more specific, Storm. Yeah, I would be more specific. I would say a long call is an insurance against high prices of an important raw material that you use. So something that you have to buy. And I would say a long put is an insurance against decreasing prices of your product. Yeah, that's how I would put it. Let me check the time. 31. Perfect. Perfect, guys. This is it for the day. I don't want to do more. I deliberately skipped the break because I think this needs to be explained in one go, that everything is fresh in one neat, I don't know, flow, I suppose. Okay? What I would like, when we meet again early next week, we will do, of course, a brief recap, and I want that the recap is already interesting. That are just basic option types, but you can, of course, combine them. Imagine you are not only long a call, but you also long a put option at the same time on the same underlying. So you can do really weird stuff with it. So what I want to do when we meet again, warm up, where I show you how to combine them, and then we indeed hop into option pricing. So far I've simply said the option premium is €2, just accept it, but that actually needs to be calculated. That's not something that can just be invented, okay? So this is really where I want to stop. This was plenty of new content. I would like that when we meet next time, that all of you are very, very confident with payoff diagrams. Just try to sketch them out yourself, not by remembering roughly how the shape looks, this hockey stick, but really that you can construct it, okay? So I want on Monday, I think next lecture is Monday, that you are familiar with the terms, that you know long, short, call, put, strike price, underlying, that this is kind of familiar, and that you can draw the basic option types. That is it. I don't have more for today, guys.
One question regarding the short put. Just if I look at the diagram, it doesn't really make sense because we have a restraint in the profit we could make, but we could make infinite losses. So why would you engage in a short put and in what kind of situation?
Yeah, that's exactly what I said before, where a lot of students struggle with understanding this. It depends on your expectation. If you say the probability of a market price in the future between €8 and plus infinite, the probability for that is 99.9%, why would you not do that? Because then you say, well, why should I not pick up the €2 here? That's kind of a, it's a no-brainer then. So that depends on your probability. So what do you expect will happen? If you're reasonably certain that the price will be above €8, then you would happily be short. If you say, I actually think with a probability of 99.9% that the market price in 1 year will be below 8, then you would never be short, of course. So it's only a matter of what you expect. All right? Super, guys. Good job.
I also have a quick question.
All right, bring it.
So do strike prices of options change with stock splits?
Yeah, strike prices are not necessarily connected to stock splits, right? So theoretically, you could agree on any strike price you wanted. If you trade standardized options at an option exchange, there of course would be a link. Otherwise, if you were long a put option, you could easily capitalize on stock splits. So there would be then adjustments, yeah. But in principle, you and me can agree on any kind of option contract, and theoretically we could agree on any strike price as well. Yeah.
Okay, thank you.
Really good job, guys. Enjoy the day. Like I said, try to make sure that you're relatively proficient with payoff diagrams next time we meet. And we will do the major part of option pricings then as well. Really good job, guys. Have a great day. And I think I see you next time on Monday in usual awesomeness.
Thanks a lot.
See you guys. Doei doei.